In colonial America, there were no modern banks. Colonists either gave credit to each other or used credit stemming from merchants and banks in Great Britain. Alexander Hamilton worked with Robert Morris to create the first American bank, the Bank of North America, in Philadelphia. 3 years after that, merchants from Boston founded the Massachusetts Bank and Hamilton founded the Bank of New York. These three banks were the only banks when Washington became president, and these banks were local banks and not part of a single banking system. Alexander Hamilton became the first Secretary of the Treasury, and he worked towards implementing a more modern financial system in the United States. He fought for a national bank which was eventually founded on February 25, 1791, named the Bank of the United States. The bank had 20% of its shares owned by the federal government. It had the power to open branch banks. There was much controversy regarding a national bank, with many opponents claiming that it was a threat to states' rights or unconstitutional, or both. The creation of the Bank of the United States prompted state legislatures to charter more state banks, which grew from around 30 in 1800 to around 1500 to 1600 on the eve of the Civil War. The charter for the first national bank came up for renewal in 1811 and was defeated. This was followed by an expansion of banking as the number of state banks grew drastically. The value of notes in circulation also grew. The lack of a central bank caused financial issues for the United States, emphasized by funding issues during the War of 1812. This led Congress to charter a second Bank of the United States. President Andrew Jackson was not supportive of the national bank and vetoed an attempt at rechartering the bank years before the current charter ended. The national bank then became a campaign battle between him and his opponent Henry Clay in the 1832 election. After his victory, Jackson used an executive order to end the deposit of government funds into the Bank of the United States. After the order, the deposit of government funds went into state charter banks referred to as Jackson's pet banks. The second national bank officially closed when its charter expired in 1836.
The free banking era started around 1837 and ended around 1863. Prior to 1837, banks encountered several issues as mentioned before. One of them was that a bank could only be chartered by a specific legislative act. But in 1837, banks no longer have to obtain special consent from the state legislative because of the Michigan Act. It allows banks to be automatically chartered as long as they fulfill the Michigan's chartering requirements. With the new act, the banks could issue bank notes up to the market value of the bonds, and banks were also required to redeem their notes on demand in gold or silver coin. In other words, people are allowed to withdraw gold or silver coins from banks with the banknotes they received from the bank that they deposited their gold or silver coins. The states were still in charge of regulating the reserve requirement, the capital ratio, interest rate for loans and deposits. Soon after this act, New York and other states have also started to implement the free banking idea. Of course, in the early years of free banking, many problems arose. One of them was that the banking industry degenerated into wildcat banking because of the negligence and exploitation of state laws. Banknotes were issued against little or no security, and banks overexpended their credit, causing nearly worthless currency flowing. The real value of a bank bill was often lower than its face value. People started losing confidence in banks due to its questionable securities such as mortgages and bonds. These depressions brought waves of bank failures. In particular, the multiplicity of state banknotes caused great confusion and loss. The problem of this free banking era was the banks were only free of federal regulations, but they were still regulated by the states, and every state had different regulations of banking, which was the root cause of the confusion. To combat this problem, the Congress passed the National Banking Acts of 1863 and 1864. This act was created to allow the federal government to charter the banks. It encourages development of a national currency backed by bank holdings of U.S. Treasury securities that provide more stronger and concrete security to the people.